Hello everyone, and welcome to this webcast delivered by the ISM Trust. My name is Trevor Ford. I'm a member of the ISM Council, and among many other things I work as an accountant. A few things before we start. I need to tell you that the content of this presentation is for information purposes only. It's not intended to be a substitute for legal or other professional advice, and it shouldn't be relied upon as such. The ISM members can contact the tax helpline or the ISM legal team if you have any specific questions. The webcast will be available to view on the ISM's website at ism.org/webinars. I'm going to divide this presentation into two halves, and the first half will be looking at the basic rules of the exciting subjects of income tax and national insurance. And then the second half, I'll be focusing on the specific issue of self-employment. If at the end of this webcast you have any questions which can't be dealt with by the tax helpline or the legal team, do feel free to send an email in, which can then be forwarded on to me, and I can deal with specific questions for you. But I would remind you that the ISM does have a daytime tax helpline, so if at about 5 o'clock in the afternoon you feel you have a burning question which needs answering immediately, do feel free to give the helpline a call. There is also, of course, lots of information on the website of HM Revenue and Customs. That's www.hmrc, HM for Her Majesty, because she still owns it all, of course, .gov.uk. So off we go. I think, as many of you will know, the UK fiscal year, that's the tax year, ends on the unlikely date of the 5th of April. Many other countries, China, Russia, France, and so on and so forth, have a fiscal year which ends on the extraordinary date of the 31st of December. I wonder why they chose that. But being British, we have this crazy date of April the 5th. And if you're interested in the history behind that, you can go onto Wikipedia and you'll discover that the history goes right back to Julius Caesar and ends with William Gladstone in the middle of the 19th century. So at the moment that I'm talking, we are about 4 weeks away from the end of the tax year 2018 to 19. In this year, pretty well everybody has a personal allowance. That's an amount you can earn before you start to pay tax of £11,850. £11,850 is the personal allowance for the 2018-19 tax year. And the year before that, the year ending 5th of April 2018, the personal allowance was £11,500. Not absolutely everything that you receive in money is taxable. Some things are outside the tax system, and it would probably be helpful if you know what they are. Grants and scholarships, generally speaking, are not taxable. So if you are a student and you're receiving finance to help you with your studies, you won't, generally speaking, have to pay tax on that. If you win a cash prize while you are a full-time student, and that prize is from the institution at which you are studying, then that also will be outside the tax system. On the other hand, prizes generally are taxable, and I occasionally find people who think that because they've won a prize they don't have to pay tax on it. Of course, some people pay tax on their prize income because that is actually their main source of income. If you're a tennis player or a golf player, for example, most of your income will be from prizes. So if you enter for a piano prize and you win €5,000, that is part of your taxable income because it's part of your professional activities. There's no tax on gifts. If people give you money and that money is given to you not because you've done work for them, but just out of the kindness of their heart, there is no tax to pay on those gifts. And there is no limit on that. If your granny rings you up and says she wants to give you £100,000 because she still loves you, you don't have to pay any tax on that amount of money. And similarly, money that you inherit, that's money that's left to you in a will, is not taxable either. It's probably been already taxed at least 5 times, so by the time it gets to you, it's hardly the amount of money it was in the first place, but you don't have to pay any extra tax on that. There are no special tax rules for young people, and I occasionally get students coming up to me telling me they don't need to pay tax because they are still in full-time education. That is absolutely not the case. The tax rules apply to everybody equally, no matter how old you are. And if at the moment of your birth you have really rich parents who leave you shares and so on and so forth, then you will pay tax on the income just the same as anybody else. So the fact that you are studying does not exempt you from income tax. Neither, incidentally, are you exempt from income tax if you are studying to fund your own studies. If you are earning, I apologize, if you are earning to pay for your own studies. So if, for example, you have a profit of £15,000 in 1 year and you give all that money to the institution at which you are studying to cover your fees, you still have to pay tax on the money you earned in the first place. Now, what are the rates of income tax? After you have got past your personal allowance, that's your tax-free 11,850, you pay tax at 20%, that's the basic rate of income tax, 1/5 on the next £34,500 that you earn. So if we add 11,850 together, we reach a total of £46,350 before you have to start worrying about higher rate. You always keep that £11,850 tax-free. So in the extremely unlikely event that you were to earn £11,851, you would be £1 into the tax threshold and you would be expected to pay 20% of £1, which is 20 pence. And believe it or not, HMRC would send you a bill and they would sooner or later expect you to pay it. But because you've gone into over the personal allowance limit, that doesn't mean you have to pay tax at 20% on everything you earn. So the first £11,850 is free of tax. The next £34,500 is taxable at 20%. And if you go above that, you go into the first of the higher rates, which is 40%. And again, this doesn't mean that you pay 40% on all your earnings, but only the earnings above £46,350. There is a higher rate of 45% that's only relevant to people with an income of more than £150,000 a year. And if you, like me, are a professional musician, that's extremely unlikely to be the case. I should probably also mention that there are different tax rates in Scotland. And if you are a resident in Scotland, you just ought to check with the HMRC website. The differences are not great, but you can find yourself with a slightly lower or slightly higher tax liability if you live north of the border. Let's next look at the national insurance rates. National insurance is actually very similar to tax, although it was originally the idea that national insurance would fund the state pension and the National Health Service. And I have to say, the way the state pension is going, the age at which you will receive it is progressively moving away from you. So if you're currently in your 20s, you're probably going to be 90 by the time you actually get your state pension. And I have to say, if the National Health Service considers the way it's going at the moment, you might not actually live that long anyway, and it's quite possible that the state pension will be something you never actually get. Anyway, putting that to one side, let's have a brief look at the national insurance rates. There are 4 classes of national insurance, and class 1 applies to people who are employed, that's people with a job. And class 1 starts when your earnings are above £8,424. That incidentally is a lower threshold than the income tax rate threshold. And if you are paying class 1 contributions as an employee, then the rate once you go above £8,424 is 12%. There are different rates for self-employed people. Self-employed people pay class 2 national insurance, and that is currently a flat rate of £2.95 a week. But that starts when your earnings from self-employment go above £6,205. That's an even lower starting threshold than the employment threshold and way below the personal allowance limit. There is a class 3 rate, which is a voluntary rate for people who are not earning money but want to keep their state pension entitlement intact. Let's leave that one for the moment. And then there is a class 4 rate, and that is also for self-employed people. That starts like the Class 1 rate when your income is above £8,424, and that's charged at 9% of your profit. So what's the true tax rate? It's not actually 20%, it's much more like 30%. That's not far off 1/3 of your earnings, and that's why this is a really important subject for you. But let's just look back at that anomaly about the starting rates before we go any further. Yep, income tax doesn't apply until you're earning more than £11,850. If you're employed, you start to pay Class 1 national insurance when your earnings are above £8,424. But if you're self-employed, you have a national insurance liability as soon as your profits go above £6,205. It's quite possible, therefore, to have a national insurance liability when you are still well below the income tax threshold. Let's move on. How does HM Revenue and Customs get its money out of you? It's worth mentioning at this stage that there are a number of different types of income tax. In the old days, and some of you will remember this, there used to be what were called schedules of tax: Schedule A, Schedule B, Schedule C. Self-employment was called Schedule D tax, and employment was called Schedule E tax. But that was considered to be far more too complicated for people, and so those terms were abolished some years back. And we now just have tax on things like investments or property or employment, which is one we're going to look at a moment, and self-employment. So the old Schedule D has become self-employment tax, and the old Schedule E has become employment tax. Now, the vast number of people who work for a living in the UK are employed. That means there is a two-way relationship between the employer and the employee, and there is something in existence called a contract for service. When you're employed, basically you turn up for work, you do what you're told, you can't take time off just because you feel not coming in, and you can't send a friend or a deputy to do your work for you. In return for that commitment, you are paid a salary, and you receive that salary even if there's no work for you. And you occasionally hear the example of car workers in a factory being told that they've made too many cars and they're not being sold, and they can go home and do some gardening for a few days, but of course they still get paid. And if you're employed for more than 2 years, then all sorts of nice rules come in which prevent your employer firing you for no reason. If you're employed, your employer effectively becomes a tax collector. They have to notify HM Revenue and Customs that they've taken on a new member of staff, and HMRC sends out something called a PAYE coding notice. PAYE, as many of you will know, stands for Pay As You Earn, and you'll discover why it's called Pay As You Earn in a moment. People are really puzzled by PAYE coding notices. They're a mixture of numbers and a letter at the end, but actually they're quite simple. What they actually tell the employer, or more likely the employer's computer, is how much that particular employee is allowed to earn before they have to start paying tax. Only the last digit of the number is knocked off for some peculiar reason, and that's where the confusion lies. So in the current tax year, where you're allowed to earn £11,850 before tax starts, the standard tax code is 1185, and usually there's an L stuck at the end, which means that you're entitled to the lower rate of personal allowance, and that harks back to the day when people of a certain age were entitled to a higher rate of personal allowance. So in those days it was quite common to have an H after your tax code, and then HMRC abolished the H rate, and so everybody now has an L, and I suppose the L arguably is completely redundant. Now, how does it work? Well, if conveniently you were on a salary of £24,000 a year, you might expect quite reasonably to receive £2,000 a month when your paycheck came through. But when you actually look at the amount of money you receive, you'll discover that you've actually got something more like 1,600. The employer's computer has calculated the tax that you owe. The employer has held that money back, and once a month or once a quarter, that money will be sent off to HMRC. At the end of the year, on April the 5th, you are given a certificate called a P60. Many of you will already have seen one of these, and the P60 has your employer's name on it, your name on it, the reference number of the tax office that's got your money. It will show how much you earned over the previous 12 months, what your PAYE tax code was, and how much tax you've paid. You receive a copy of that. A copy goes off to HMRC for checking, and basically that's the end of the story. And the system does have lots of advantages. For a start, the money that you receive, you can spend. You haven't got to save up to pay your tax bill later on. In general, you won't have to fill in a tax return. The only pieces of paper that you see from HM Revenue and Customs will be your PAYE coding notice, which you probably won't understand anyway, and your annual P60. And if you change jobs halfway through the year, you'll also receive something called a P45, which does nothing more than transfer the figures over to the new employer. Disadvantages? Well, there are a few. I have to say it would be nice to see the money for a moment before HMRC ran off with it. The primary disadvantage of employment, though, from a tax point of view, is that in general, you're not allowed to claim expenses. It's no good you saying, for example, that your season ticket cost you £3,000 last year so that you could get to work and therefore you should pay less tax. No, it doesn't work like that. Neither even is there any point saying that you subscribed to a really useful publication which helped you be a better whatever you happen to be in your job, and because of that you managed to obtain a promotion. No, it may have been helpful, but that doesn't mean you're going to pay less tax as a result. I'm going to quote one piece of tax legislation at you, and I promise you it's the only bit I'm going to quote today. And the tax legislation says that if you wish to claim an expense when you are employed, the expense has to be, and here's the quote, wholly, exclusively, and necessarily incurred in the performance of your duties. Let's just look at the two halves of that. In the performance of your duties, that means while you're actually working. So that immediately knocks out any claim for the cost of getting to work and getting home afterwards. But it's the first half that's important. The expense has to be wholly, exclusively, and necessarily incurred. And it's the word necessarily that HMRC really focuses on. And they interpret that as meaning that if you could do your job without incurring that expense, without paying out that money, if you could actually do the job without it, no matter how helpful, desirable, or whatever that expense might be, then you can't claim it. Why is that? Well, obviously the main reason is to keep the tax money coming in at a higher level. But I suppose the other reason is that if every individual employee was allowed to claim money against their tax for expenses, then the whole system would be swamped with people sending in tax claims every year, and PAYE would grind to a halt. So in which circumstances is it possible for an individual to claim an expense as necessary when they are employed? Well, interestingly, there is one case where musicians can claim expenses, and that is orchestral musicians who are employed in an orchestra, because of course they have to supply and keep in good repair their own instruments, and they very often will have to supply also the rather funny clothes that we have to wear when we perform on stage. Those items are not provided by the employer. That's very unusual, of course, because most people, when they have a job, find that the equipment that they need to do their work is provided for them, not so orchestral musicians. So because they have to keep their instruments in good order, and because they have to provide their clothing, and without those items they cannot do their job, then we here have straight away an example of an expense which is necessary, and HMRC for that reason will unusually allow a claim for expenses even though you are employed. There is one other allowance which everybody is allowed to claim if they are employed, and that is a subscription to an approved professional organisation. And HMRC maintains a very long list, if I may say so, of organisations which are considered approved professional bodies. Trades unions are not on that list, but incidentally the ISM is, and that means that whether you are employed or for that matter self-employed, and we'll come to that in a moment, if you pay an annual subscription to the ISM, then you are entitled to pay less tax. Let's move on and look at self-employment. This, of course, is totally different. There is no employer. You are basically in business if you are self-employed. And the rules are fundamentally the same whether you are an individual working entirely on your own in self-employment or a multinational company. And that basic rule is that you are taxed on your profit because, of course, you receive no salary. You only earn money when you're working. There is no guarantee from anybody that you will receive money at any time other than when you're actually earning it. And profit, of course, is your income minus your business expenses. There are a number of big differences, therefore, in the tax system. Pay as you earn can't operate. If you earn £1,000, then you receive £1,000. HMRC couldn't instruct your private pupils to deduct 20% of the lesson fee and send it on to them every time they'd come and visited you. So you receive what you earn. You also, therefore, pay your tax much later, and in some circumstances, considerably later. The typical scenario is that in year number 1, you're earning your money and paying out your expenses. In year number 2, you're preparing your accounts and you're sending in your tax return. And in year number 3, you're paying the tax liability on year number 1. This implies that there is an element of self-control required. Equals if you go out and spend the money before you pay the tax bill, then you will find yourself with a problem later on. The other problem, of course, is if you have a really, really good year followed by 2 really bad years, the big tax bill for the good year comes in the second year of the bad years, and it's no good going along to HMRC and saying I ran out of money and spent it. You have to put money to one side, and you need to put it somewhere where you guarantee that you won't spend it before the tax is paid over to HMRC. The biggest difference, though, is in the tax legislation. And I'm just going to go back and quote that rule again, but I'm going to quote it as it's written for self-employment this time. And the rule says that to claim an expense when you are self-employed, the expense has to be wholly and exclusively incurred in connection with the trade, profession, or vocation, as it says. That word necessarily isn't there. Now, if you're self-employed, this means that you can claim all your business expenses. Why is that word not there? How could HMRC define which expenses are necessary when you're self-employed? Let's forget music for a moment. Let's look at somebody who runs a restaurant. My restaurateur will be receiving money every night from his customers who come in for a meal, but out of that money, he's going to have to pay his chef, he's going to have to buy food, he's probably going to have to be renting the property, he's going to be printing menus, he's going to be advertising, and so on and so forth. At the end of that process, he's left with his profit. Now, HMRC come along and say, we're going to try and define which of your expenses are necessary. Right, you've got 14 customers in tonight, but you've got 25 tables, so half of those tables aren't necessary, so you can't claim the cost. You've got a menu, but surely you could just walk out here and announce what the food is tonight. You don't actually need a menu. And you've got flashing lights in the window that may attract customers, but you don't actually need flashing lights if you're a restaurant. So no, it doesn't work like that. When you are in business, you decide how you can best make a profit. And it's not for HMRC to come along and tell you which expenses you can and cannot incur. Also, of course, if a business was only allowed to claim necessary expenses, there would never be any business development. There would never be any new products, because, of course, developing a new product is not actually a necessary thing for a business to do. So we can put that word necessary to one side now, because it doesn't apply when you are self-employed. If you're self-employed, you spend money on running your business, and provided that expense generally relates to the business you're in, then HMRC has to allow it. So let's just summarize the differences between employment and self-employment. If you're employed, you receive a salary from your employer, unless you're on one of these ghastly 0 hours contracts, when it's a miracle if you receive any money at all. If you're self-employed, you pay tax on your profit, if there is any. Of course, if you're self-employed, in some circumstances, you may actually make a loss. But of course, HMRC doesn't come along and subsidize you, if that's the case. If you're employed, you will pay your tax under the PAYE, pay as you earn system, and that will be looked after by your employer. If you're self-employed, you'll receive your money gross. You receive the money that you earn in full, but you have to pay the tax later on. If you're employed, you probably won't need to fill in a tax return. If you're self-employed, you're going to need to prepare accounts, and you're going to need to submit a self-assessment tax return every year, and you'll make your tax payments direct to HMRC. And incidentally, if you're self-employed, those payments typically are made at the end of January, shortly after Christmas, when you absolutely have no money, and at the end of July, just when you were thinking of having a summer holiday, and then you change your mind. If you're employed, you can only claim expenses which are absolutely necessary to enable you to do your job. If you're self-employed, you can claim all your business expenses. HMRC can't even tell you that you have spent too much money. If you decide to travel by first-class rail when you are working, they can't come along and say that you could have done it cheaper by traveling on standard class. That's not their problem. I suppose you could actually decide never to pay any tax if you were self-employed by spending all the money that you earned on expensive business expenses. You would have no tax liability because you had no profit, but at the same time, you would have no money. It's not unusual, of course, for people to be employed and self-employed at the same time. A musician typically might be working in the school on Monday and Tuesday of every week, and then for the rest of the week, they are self-employed, private teaching, doing concerts and so on and so forth. Incidentally, there's no point going along to your part-time employer and saying, but I'm self-employed, you mustn't tax me at source. It doesn't work like that. The regulations apply to the type of job you are doing, and it's not unusual to be treated as an employee on Monday and Tuesday and as self-employed for the rest of the week. But the fact that you are self-employed between Wednesday and Sunday doesn't mean that you can claim self-employment status when you are employed for the first part of the week. So we're going to spend the rest of this webcast looking specifically at self-employment, and most musicians are self-employed at least to some extent. Could I start by making a possibly slightly difficult comment here? It's important that when you are self-employed, you are honest with HMRC. There is a rumor around parts of the music profession that if you are paid in cash, HMRC will never find out, and I'm afraid that is absolutely not the case. Many years ago, the tax office, in the days when it was called the Inland Revenue, used to examine every individual set of accounts in some detail, and they would write back and ask questions before they passed them. That doesn't happen anymore. Everything now is basically computerized. Most people send in their tax return online, and accounts are submitted in 3 lines: your income, your expenses, and the bottom line, which is one minus the other, is your profit. And the HMRC computer watches out for anomalies and then reports them to a real live person. There's the occasional spot check by HMRC, but they're also busy these days trying to sort out Brexit, that they've actually got very, very little time for checking. But that doesn't mean that if you are dishonest, they won't one day catch you. There is, of course, also the moral issue that defrauding Her Majesty's Revenue and Customs is not the thing I would hope you might be thinking about. But they do keep an eye on people. And after the financial crash some 10 years ago, HMRC, under government instructions, attempted to maximize tax revenue by setting up what they called task forces to pursue major areas of tax evasion. And surprisingly, one of the very first ones they set up was to look very closely at private music teachers. I wonder why that was the case. A friend of mine, who for obvious reasons I shall not name, is a guitar teacher, and I know that he was teaching a large number of pupils for cash and leaving the income undeclared, and he was quite convinced that HMRC would never ever catch him. One day he received a telephone call from an individual who said, I'm interested in guitar lessons. What do you do? And my friend said, well, I charge £30 an hour, but it's all in cash, and it's a slightly lower rate than I would normally charge. I hope you understand why that is. And the chap said, yes, very interesting, thank you very much. I'll call you back if I'm interested. About 4 weeks later, he received an invitation to attend a meeting at his local tax office. And when he got there, the tax inspector said, do you do any private teaching? And he said, no, I don't do anything like that. And the tax inspector said, very interesting, because when I rang you up about guitar lessons a few weeks ago, you told me it was £30 an hour. Are you going to be honest with us today then? It was a very, very expensive meeting for him. So please, can I start off by saying, don't push your luck. Your objective is to pay the minimum amount of tax that you can legally, and that is not the same as tax evasion, which is quite a serious crime. You are unlikely to end up in prison, but you are very, very likely to end up with an enormous tax bill and some rather horrific penalties. Having said all that, the music industry is one of those unusual industries where lots of people end up being self-employed long before they are actually registered with HMRC. Many music students are actually teaching and possibly even doing a small amount of work long before they actually become registered with the tax office. You may be part-time self-employed and not need at this stage to register with HMRC. It's only when your income goes above one of the thresholds that you become liable to register. So if, for example, you are a student and your earnings are only £3,000 a year, it would be a good idea to keep a record of them just in case HMRC come along and ask you some questions about it. But until you actually go above that tax or national insurance threshold, you don't actually need to do anything particular about it. Let's have a look at the expenses that you can claim when you are self-employed. I tried some years ago calling HM Revenue and Customs. You end up holding on the phone for about half an hour before anybody answers, but you do eventually get through to their advice line. And I tried asking them what expenses a musician was allowed to claim. And they said, can you tell me a little bit about yourself? And I said, well, I work as a freelance musician, mostly in the classical field, and I'm interested in knowing which expenses I'm allowed to set against tax. And the woman I spoke to was extremely friendly, said, oh, that is extremely easy, we can answer that question. And I waited with bated breath, and she said, you can claim any expenses which are wholly and exclusively incurred in connection with your business. And I said, I know that bit, but I'm a musician and I want to know something a bit more specific. And she said, I think you need to talk to your professional association or perhaps to your accountant. And thinking about it, that was actually the right advice, because HMRC is certainly not going to produce a tax inspector who is an expert in the music profession, and each of us will have a very different lifestyle and business lifestyle where we may be incurring expenses which nobody else has even thought of at this stage. So it's for you to assess which expenses you think you can claim, and it's for HMRC occasionally to disagree with you. If you go onto the business pages of the ISM website, you will discover that there is information about expenses which you can claim. If you happen to be a member of the Musicians Union and you look at their annual handbook, you'll discover there's a list of expenses there, but it's not quite the same as the ISM one. And if you're a singer or an actor and you're a member of Equity, they will also produce a list of claimable expenses. But again, it's different for the MU list and it's different from the ISM list, and that's quite right, because there is no official list. And so I suppose I'm going to give you my own list, but it's not going to be the same as anybody else's list, but it will give you an idea of the expenses which normally a freelance self-employed musician will be claiming. Some of these, of course, are very obvious. Let's start off with sheet music. scores, and music books. And bearing in mind again that the necessary rule doesn't apply, you don't actually have to prove that you are going to be performing the music that you buy. If you decided that you wanted to go out and buy the complete works of Bach because it would be professionally useful for you, HMRC would not be able to insist that you could prove that you were a Bach specialist. So sheet music, scores, and music books. And similarly, recorded music, and that could include CDs and DVDs and downloads and possibly your Spotify subscription as well. And of course, again, HMRC cannot define the style of music. You may have a classical training, but if you are teaching pupils who happen to enjoy listening to rock music, and it's useful for you to know the sort of thing that turns them on, then if you decide to go and download some rock music for your personal pleasure, then it's entirely up to you, and HMRC would not be able to say that you couldn't claim it. Another obvious one, of course, would be instrument maintenance and tuning. And also fees paid to other musicians. Well, why might you want to pay fees to other musicians? You may engage a deputy to cover your private teaching, or you may hire an accompanist. You may send someone to play in a concert for you with permission from the fixer. You may go for some coaching sessions. You may typically perhaps supply a group of musicians for a corporate event, and the whole fee comes to you, and then you pay the other musicians out of the money that's been paid to you. So the money that came to you in the first place would count as your earnings and would be declarable as such, and then the money that you paid to the other musicians would be your own business expense. Traveling expenses. The rules say that you can travel between places of work and claim the cost. But for what is called an itinerant worker, that is somebody who travels from place to place when they are working, you are allowed to claim from your business base, which is your home, to wherever you need to travel to while you are working. Musicians, freelance musicians particularly, are what is called itinerant, and therefore the cost of traveling from home to a rehearsal, to a concert, to a music shop, to see your accountant, and so on and so forth, would all be allowable. The only time they will not accept a claim for travel is if you have a very regular place of work. In other words, if you cease to be what is called itinerant. So if all your work is at the same place every day, and that's the only place you go to, then HMRC will in general not allow the cost of traveling there. Neither, incidentally, will they allow the cost of travel if you choose to live many, many miles away from the place where you normally work. So if you are a musician who works mostly in London and you decide that you want to go and live in Cornwall because you like the weather down there, then traveling up to London every day would not be considered an allowable tax expense because you were living away from your area of work by choice. The cost of running your car is an allowable expense, and there are two ways in which you can do this. You can either add together all the running costs of the vehicle, that'll be your tax and your insurance and the fuel and the repairs and servicing and so on and so forth, and claim an appropriate percentage to allow for the fact that there is some private use of your vehicle, or otherwise there are approved mileage rates, generally speaking 45 pence a mile, which you can claim instead. And there isn't time now to explain the benefits of one against the other, but it's a good idea to talk to an accountant if you're not sure which is the one that's going to work for you. And then we have hotels, overnight stays. If you need to work away from home and stay away overnight, then you can claim the cost of the hotel, the bed and breakfast, the digs, call it what you will. And then with that would go a claim for meals. In fact, you can now claim for meals not as you used to, but the rules used to say you could only claim when you were working away from home with an overnight stay. The rules now are a little more generous, and they basically say that if the journey is tax allowable, then the meal that you take on the journey is tax allowable. So if you're working away from home, then any meals that you necessarily take while you're traveling around would be considered an allowable business expense. But again, if you're going to the same place night after night, then that rule would be suspended. So if, for example, your job is working in a West End show, then you're not allowed to go out after the show and claim the cost of dinner every night because it's a regular place of work. Incidentally, you cannot claim the cost of buying food for other people unless they are working for you. So taking your agent out for dinner and hoping that that might persuade him to get you even better work would not be allowable. You don't actually have to have a meeting in a restaurant. So HMRC has specifically banned the cost of claiming for what they call entertaining. So taking people out for a meal is not considered an allowable business expense. You can claim, as I've mentioned before, for the cost of special clothing that you have to wear for public performances. This has to be special underlined clothing. You can't claim the cost of everyday clothing simply because you happen to wear it at a rehearsal or a concert. Neither can you claim the cost of looking smart, even if you wouldn't normally look smart when you were working. So if you choose to put on smart clothes when you go and teach, whereas you would normally look rather scruffy, shall I say, at home, you can't claim the cost of those clothes because they are ordinary everyday clothes. Even if your employer were to insist, or your engager were to insist, that you needed to look smart when you came into work. So special clothes, maybe the clothes where you would be looked at in a slightly unusual way if you were wearing them in a bus queue. So for men, I suppose we're looking at things like dinner jackets and tails and frilly shirts and bow ties. And for women, it's long skirts and long dresses and floral things and colourful things, which men, generally speaking, wouldn't even entertain. But there you are, special clothing for public performances. And of course, dry cleaning those clothes and maintaining them as they start to wear out, or as your fans start to attempt to rip them off you as you leave the stage at the Wigmore Hall, then the cost of having your special clothes repaired would be an allowable business expense. As incidentally would be hairdressing and cosmetics for public performances. And I shall leave you to work out whether a haircut directly relates to a public performance or not. Telephone bills for your landline and for your mobile and your broadband subscription would also be tax allowable if you are self-employed. And as with the car, we'll be looking at a business proportion. It's for you to define what that is and be prepared to defend your choice of percentage if HMRC do query it. If you are claiming 95% of your mobile phone bills, but you happen to have a boyfriend or a girlfriend who is based in the USA and you telephone them every night, then HMRC will spot that from your itemized bill. So a reasonable proportion of your landline, your mobile phone bills and your broadband subscription. And if you're an orchestral musician and you are subscribing to an answering service or a diary service, then that would be considered to be an allowable business expense as well. The cost of insurance, not just the cost of insuring your instruments, but the cost of insuring your other business equipment, which may be kept at home, and that would imply therefore that a proportion of your house contents insurance might relate to your business, and that too would be claimable. And as an aside, if you have instruments and they are not insured, and I'm occasionally horrified to discover particularly young professionals who have no insurance on their instruments, then please do something about it. If your instruments are stolen or seriously damaged and you have no insurance, then that might quite genuinely mean the end of your career. Instruments have a habit of having accidents or being taken. And if you don't get them back and you have no money to buy replacements, then you are in a serious situation. So please make sure that your instruments at least, and perhaps your other equipment as well, are covered by insurance. Postage and stationery, and there's another one. That may not seem significant, but if you're buying ink cartridges for your printer because you're doing a massive mail out, then the cost of stationery can actually be quite significant. Advertising and publicity, and this could include having your photo taken or keeping your website in good order and so on and so forth. So postage and stationery. And journals, music magazines, magazines particularly connected with the music profession, but this may include, I suppose, buying the Radio Times to see your Radio 3 listing, or perhaps buying an ordinary newspaper to see if they've written up the concert that you did last night. Concert tickets, going to listen to other musicians perform. HMRC occasionally challenges claims for concert tickets. They claim that this is musicians just going out for the evening being entertained. That is absolutely not the case. We go to concerts because we have to keep in touch with changes in performance practice, we have to listen to repertoire, and we actually have to network with other musicians. And I have on occasions persuaded a tax inspector that the networking aspect of going along to concerts, meeting other people there, is a genuine business expense. And after some explaining, HMRC generally will allow the cost of going to listen to other musicians. And of course, if you decide to go to the cinema, if you're on the soundtrack, then that would probably be a claimable expense as well. As would, of course, if you're going to a concert, the concert program and the cost of traveling there, and possibly with a little imagination, maybe even the meal afterwards if you can get home again in time. Conference fees and seminar fees. You are allowed to claim for the cost of keeping your knowledge and professional expertise up to date, and that is quite reasonable, therefore, to claim for the cost of going along on a course, or going to a seminar, or going to a conference. Let's look at some more interesting ones. Accountants' fees and solicitors' fees will be allowable. If you hire a professional accountant, and please don't try and do this yourself, if you hire a professional accountant, then the fees that you pay to the accountant will be a business expense, which means that they are reduced in cost by, I suppose, 30% for the basic rate taxpayer who is paying tax and national insurance. And if you hire a lawyer maybe to draw up a contract for you, then the cost of that professional advice would also be considered tax allowable. Interest on money that you borrow for professional purposes. You may need to buy a new instrument or a car, and you haven't got the cash in the bank at the time, so you borrow money to finance the purchase, and the interest you pay would be considered a reasonable business expense. Incidentally, HMRC in general will not allow claims for interest on credit cards, and neither will it allow claims for interest when you go overdrawn. So if you do need to borrow money, then you need a standalone, easily identifiable, specific loan agreement, credit agreement, whichever it happens to be, so that you can see where that money has actually been taken from. It is also possible to extend your mortgage if you're going to make an expensive purchase, let's say a very, very expensive stringed instrument, and in those circumstances, a proportion of your mortgage interest will be labelled as relating specifically to that particular item of equipment, and you'd be allowed to claim that interest against your tax liability. You can also claim for using a room at home as your music studio, and that claim can be quite significant if you are spending a lot of time working at home and particularly teaching. There are a number of ways of working out the claim, but basically we're looking at claiming a proportion of your rent or your mortgage interest, your council tax, your gas and electricity bills, and your house insurance. And how do we do that claim? Well, let's give you an example. Let's imagine you live in a house with 4 rooms, and one of those rooms is occasionally used as your music studio. So straight away we're down to 1/4 of your expenses, because that is the amount that directly relates to that particular room. And if that room is your living room, and let's say for 1/3 of the time the room is used, it's being used for professional purposes, and the other 2/3 of the time it's being used for private purposes, then we'd be looking at a claim of 1/3 of 1/4. See how that works? Let's look at a different example. Let's imagine that you've moved up the property ladder a bit and you've got a 12-room house, and one of those rooms is your music studio, and it's used almost exclusively for professional purposes. Then we'd be saying 1/12 of the expenses relates to that one room, and maybe 90% of 1/12 would be the claimable amount, because your music studio was used nearly all the time for professional purposes. It's not, incidentally, a good idea to say that any of your house is ever used solely for professional purposes. It can cause problems when you sell the house with capital gains tax. Extremely unlikely that it's a problem, because actually for once the tax law is designed to be generous. HMRC does not want to charge tax on private houses, but if you say that part of your house is used solely and exclusively for business purposes, then it is just possible that you will run into trouble with HMRC and capital gains tax. All you need to do is to go and sit in your music studio with a newspaper for 5 minutes a week and read it there, and believe it or not, that would be sufficient to prevent HMRC charging capital gains tax when you come to sell your private house. And of course, the cost of keeping your music studio in good decorative order. Your music studio is, I suppose, your shop, and anybody visiting you would expect it to look in reasonable condition. And people who work in your particular music studio, your shop, are actually wearing out your decorations. So periodically painting and decorating and putting in carpets and curtains into that room would be a claimable expense. But once again, we would apply the business proportion. So if your music studio is used 90% for music and 10% for reading the newspaper, and you put a new carpet in there, then we'd be looking at claiming 90% of the carpet. And so on and so on. I suppose I could sit here for another hour going through lists of expenses which self-employed musicians can claim, but I think you ought to be getting the idea of it by now. I tend to suggest that you think of it in a positive rather than a negative way. Let's put it this way. I'm going through a list of what you can claim rather than a list of what you can't claim. Think of it the other way around, because if you're a musician, pretty well everything you spend will somehow relate to your work. So think about claiming everything apart from what you can't, rather than thinking about claiming nothing apart from what you can. Now, the things that you can't claim are the things which are solely personal. And generally speaking, that will mean the clothes that you're wearing when you're not at work. It will mean the food that you eat at home. And it will include things like going on holiday and buying gifts for your friends and family. But beyond that, pretty well everything you spend will either in full or in part be related to your work as a musician. And if you think of it that way round, what can't I claim rather than what can I claim, then you'll have the right mindset for making sure that you don't miss any expenses. Please get hold of receipts when you can. A bank statement listing a payment by debit card is not a substitute for receipt, simply because the entry on your bank statement doesn't actually say what you bought. If you go into a department store and you buy something which is relevant to your business, you need to be able to prove what you actually spent the money on. And an entry on a bank statement that just gives the name of the store and an amount doesn't actually fulfill that purpose. Now, all these expenses so far are day-to-day running expenses, but in addition to that, you'll be spending money on equipment. Now, how do we define equipment? I suppose equipment is something where there is a resale value. If you buy equipment, then before it wears out, you could actually sell it again. And that isn't the case with all the things I've talked about so far. If you go and buy a postage stamp or a rail ticket, once it's used up, it has no value, whereas equipment to some extent keeps its value. And there are different regulations applying to claiming expenses. There is a system in force called capital allowances, and the rules for claiming capital allowances are slightly different from those for claiming ordinary day-to-day expenses, which are called confusingly revenue expenses. Now, the rules keep changing. The government tends to change the rules on capital allowances pretty well every year. But at the moment, there is something in existence called the annual investment allowance, and that means that any self-employed person can deduct the cost of equipment they buy just as if it were any other business expense up to the value of £1 million in any tax year. Now, I think most of you will be quite comfortable with that limit. If you're expecting to spend more than £1 million, then do send me an email. I should be delighted to hear from you. But most musicians will be more than covered by a limit of £1 million a year on their equipment expenditure. So you have the option, if you wish, to claim your purchases of equipment directly against your income, as you can with any other expense, should you wish. But there are other options. First of all, you don't actually have to claim the annual investment allowance or the capital allowances if you don't want to. Now, why might you not want to? Well, let's imagine earlier on in your career, you have made a profit of £5,000 and that's your only income. And in that year, you've bought, let's say, a flute for £3,000 from money that you'd saved up. Well, you're already under the tax and national insurance thresholds. So claiming that instrument is not going to save you any tax at all. So you are allowed to delay the claim and claim it in a future year. Or you can make a partial claim. If you had earned, let's say, £13,000, you're just a little way over the tax threshold, so you could claim just enough to bring you down below the tax threshold and save the rest of it up for later. So there is flexibility over how much you claim and when you claim it. You can also claim if you are given business equipment. Now this seems a bit surprising, but why might that be the case? Well, let's imagine that a relative gives you £5,000 as a gift and you decide to spend that money on buying a piano. Now, we've already established that gifts are tax-free. So when you receive that £500 gift, you don't have to pay tax on it. When you go out and spend that money on a piano, we have a business expense here, and you can claim annual investment allowance or capital allowances on that. If that person had just given you a £5,000 piano, what they've actually done is short-circuit the system. So that gift is brought into your business and is claimable at whatever it is worth when you bring it into your business. So if when you go down and look at the Christmas tree the day before Christmas, and there is a present wrapped up there which looks like a piano, ask Granny how much it cost her, say thank you very much, and then claim it off your tax. And the third one, and this is most important to people who are newly self-employed, you can claim the cost of business equipment which you already owned when your self-employment began, and you claim it at the value of the equipment on day one of your self-employment, which may be more or less than you initially paid for it. And of course, this will also include anything which was given to you in the time before you became officially self-employed. So one thing to do on day one of your self-employment is to go around your flat or your house, make a list of all your business equipment, and this is not just instruments, but this will include things like your laptop. It might include a desk and a filing cabinet. It will include maybe your mobile phone. It could include other business furniture you have around. It could include a metronome. It might include a music stand and so on and so forth. But all equipment that you actually have, which you already own, stick a value against it, and that will be claimable for capital allowances, and that can significantly reduce your tax bills. Now, HMRC a few years ago introduced a simplified scheme for claiming business expenses for self-employed people. I need to stress that it's a simplified scheme which is designed to save you time and not necessarily to save you tax. I mean, why on earth would HMRC introduce a scheme which costs them money? A number of musicians have tried using the simplified scheme and their tax bills have gone up. Some professions, some businesses have benefited from the simplified tax deduction system. It doesn't work for musicians, mainly because it takes away all the flexibility over the way in which you can claim for instruments. So I would strongly recommend that you don't use the simplified scheme for claiming business expenses. I think we're probably drawing to the end of this webcast. I would suggest that you ask yourself why you needed to listen to it. And that may sound a slightly silly question because you're listening to it because you want to know the rules about income tax, but it's important that you do get good quality professional advice. Tax and accountancy is a profession just as music is. You can't learn it by buying the Bluffer's Guide to Income Tax and sitting down and expecting to get it completely right. So I would strongly advise you, if you don't already have an accountant or a professional advisor, to get some professional advice. You can certainly deal with your accounts and your tax return yourself, but of course you never know if you're getting it right or not. HMRC are certainly not going to come along and tell you if you're paying more tax than you need to. And the tax regulations are changing Pretty well weekly, actually, because tax case law goes through the courts on a daily basis, and every new ruling affects the way you claim for expenses and the way the tax system works. So if you're listening to this webinar and expecting to go off and look after your tax in future on your own, please think very, very carefully about that. If you are newly self-employed and you haven't yet registered with HM Inspector of Taxes, HMRC, please go and do that as soon as you can. You have to register by 5th of October in the second year of your business. There are actually no penalties for registering late as such, but if you register late, then you are probably going to send in your tax return late, and there are serious penalties for late tax returns. And last of all, just a reminder that the ISM does have a tax helpline, which is open during, I suppose, daylight hours, 9:30 to 5:30, I think it is. Do feel free to ring the ISM tax helpline if you need advice. And as I mentioned early on, if you have a specific question, you can either contact the ISM direct, or you can send us an email, and that I hope will be forwarded on to me if there is specific advice you need. So there we are. I hope this has been helpful. I'm doing another webcast on business setup very soon, and if you want to tune in and listen to that as well, you might find that equally useful. Thank you very much.